All right, we are live. Guys, welcome back to another episode of The Deep End. I'm going to apologize in advance. Clearly, I'm not in the usual spot. My wife, baby, and I are on vacation. It's going to look a little different. It's going to sound a little different. You might actually hear the baby in the background sometime during this episode. So I want to just preface that as a disclaimer and apologize in advance. But um, otherwise, we're going to have a fun episode. Ari, man, how are you doing? What's going on over there?
First of all, let me say, if you do hear any cries in the background, I can guarantee you it's going to be like dividend,
Yeah,
dividend,
pretty soon.
the dividend baby in your dividend Prius. Man, I'm happy to hear that you are vacationing. I'm happy to hear that you are in Newport and living the dream, your rich life. So that just
Yeah.
made my week. And thank
Oh,
you
good,
for
man.
sharing that, and thank you for being on vacation, man.
Oh,
In
my
in
pleasure.
regards in regards to what's going on over here, not a whole lot. I'm gearing up actually for what I think will be another epic week. And for those of you who did not have your head in the market this past week, we were in deep red territory, especially come Friday, and that brought a smile to my face. I poured thousands of dollars into the market, loading up on a tech ETF, just playing a broad, sector tech ETF there for the future. And I couldn't be happier with what I see right now in the market, and I can't stop buying. So, it was a great week, and perhaps we'll have another great week. I hope the market continues to slide, believe it or not. And I'd take that slide all day long as we enter or gear up to enter the new year, man. What about you?
Yeah, I mean, same over here. I was actually kind of surprised on Friday when I think my portfolio was up like 2.25% just that day. So I had a really solid day. And when the market opened, like I said, I was really surprised to see that big pop. And truth be told, I didn't really look into exactly what caused that on Friday. So any insight from you, Ari, or any of you guys here in the live chat, if there's anything specific that happened on Friday, catch me up to speed. But yeah, I will definitely take it, especially after pretty rough few days leading up to that. But kind of like you, I did buy the dip on quite a few things this past week. Picked up some more Watsco, some more Zoetis, both of which have just like just continue to punish me. Like I probably, in hindsight, probably entered those stocks a little bit too early. But how could I have known, what the share price was going to do? But nonetheless, we're buying the dip. We're lowering our average cost. Also bought some beachy properties, and I'm proud to announce, I don't remember what the annual dividend income was this time last week in our last conversation, but as all of you guys know, I'm trying to get to that 4K, $4,000 in projected annual income by the end of this year. And with the purchases from just this past week, I'm now sitting at 3,975.
Let's
So
go.
we are actually less than $25 away from hitting that goal. It's going to happen, no doubt. And in the midst of all of this chaos, just in terms of the share price is something that we cannot control. I'm just trying to stay focused on the things that I can control, and that is where my contributions go, and that is continuing to build my annual income. So that's really what I'm focused on right now, and on that side of things, it's all going according to plan. So I really can't complain too much.
It's interesting because you're smashing through your goal, and I hope by the year's end I can do the same with
Just
mine.
smash
Though I did so twice this year, I want to just get right above that $400,000 mark in the portfolio. Of course, as I'm chanting for a deeper slide
it.
into the red zone, that's more unlikely. But I am very bullish on the fact that, closing out 2025 or moving into 2026, however you want to see that, I think we will get across that hump, that $400,000 mark. And I think, overall, what we're seeing right now, with earnings, with excitement, but yet there's this, you know, hesitancy out there because the reality is, I think a lot of us just understand that tech's in some type of bubble, but it's like we've factored that bubble in and we're just going to gun right past it anyways. I think, just some scary things that a lot of investors are looking into is, all the hype around, for example, even what started really around Mark Zuckerberg's big AI announcement there, and how much he's throwing in, or rather Meta's throwing into AI in the future. And at this point, I feel like it's just becoming a spectacle for a lot of investors. But in my mind, this technology is the future, AI and quantum, and in this space. And I don't think anybody should be shying away from looking into tech. You don't have to invest in it, but I think you should be beginning to look into it. Your curiosity, should be struck. And it would be, I think, a naive move not to have your eyes at least on some tech companies.
Yeah, well, I think that's where things like, I mean, even just the S&P 500, that's why I think it's so good to even just dollar cost average into that, because that is going to give you a lot of exposure to um, the biggest companies in that space right now. So when in doubt, I think that's always going to be a pretty safe move. And I will say, like, as far as the bubble thing, because this is something I've been thinking about a lot. I made a couple videos about this. I've been getting a lot of questions about it. I think everyone's asking the same question: is AI in a bubble, or is tech in a bubble? Is that bubble going to pop? There's a lot of bubble talk lately, and understandably so. And what I've been thinking about is, number one, are we? And number two, like, is it a bad thing? Number one, to answer that first question, I have no idea. I think we'll only really know if there is a bubble with hindsight. Like, we'll only know if it's a bubble. Only know that it's a bubble after it already pops, I think, because that's just what a bubble is. It's not a bubble unless it pops, right? And so I think we'll only know that with hindsight. But also, number two, even if it is, I don't think it's completely a bad thing. I think when we look back at previous similar instances, whether it was like the dot-com boom going into or the dot-com bubble, I should say, going into, this new century, or, not century, well, I guess century, millennium, going into that back in the day, 100 plus years ago, when they were building out all the railroads, those were definitely bubbles, but I don't think that those were bad things. It's almost like it has to go through that phase. Like, there has to be this great amount of excitement, and investment into these things for that infrastructure to be built out. And over time, it's going to get adopted. It's like thinking back to just the dot-com bubble. It's like it was pretty necessary to go through that period where they were building out all the fiber. All these new companies were coming to the forefront. People were putting money into them. There was obviously a lot of hype and excitement around them, but that was a pretty necessary thing, because coming out of that, there was, as we now know, there was mass adoption for that technology. And the same thing happened with railroads. Sure, there was a lot of excitement, and a lot of companies went bankrupt building out these railroads back in the day, but someone had to go in and lay that groundwork for this technology, or that technology that ultimately changed the course of the future. And that's probably what we're seeing in some capacity here with all this AI stuff. Whether or not it's in a bubble, I don't really know. Um, there's obviously money to be made during bubbles. There's certainly money to be lost, but it does seem like overall, in the grand scheme of things, it's a necessary thing to go through if we're going to continue building out this technology. Sorry for the rant. Hopefully all of that makes sense.
Well, bubbles shouldn't scare anybody, nor should recessions and depressions. If you have time to spare in the market, you should be embracing these opportunities. Every slide, every red day. I mean, if you're not nearing retirement, these are your opportunities, your golden moment opportunities. And, my one big regret in 2020 is not throwing, absolutely everything I had into the market. And at that point in time, Ryan, I was definitely more of a dividend centric investor. But either way, there was so much money to be made. I did throw some money in that year into, for example, Royal Caribbean was a stock that I invested in. And I ended up selling out of Royal Caribbean, and I made a good sum. But if I just held on to that, even, another year longer, I would have made even more. There's just so many opportunities that are out there. When people are fearful, that's when all the real opportunities come about. And I'd rather continue to get some deep, deep red days before we
Yeah.
tap into 2026. And to your point, that's all you really have to do, especially considering the weighting in the S&P 500, is buy the S&P 500.
Yeah.
You don't have to search too far, but definitely you should be investing and you should be embracing all of the fear that's out there right now and playing off of it. It always comes down to the fundamentals. Are the fundamentals of a company healthy? What's their balance sheet look like? What do the income statements look like? Is this company actually thriving regardless of the news headlines? And I think sometimes we get too tapped into news headlines and all the fear mongering out there, especially if you're someone who gets your news from, say, YouTube, ironically, out of all places. But there's so many freaking creators out there, who are going to hype up all the fear because you get clicks. And, that's unfortunate. And then the one thing they always, you always see it, it's like some crazy thumbnail, and then everything's crashing, last chance or whatever it is. I was never keen on making any of those types of thumbnails or anything, because, it's a fool's trap, and I just hope that every investor out there is able to take advantage of the opportunity. I was on a podcast actually earlier, which Ryan, I'll speak to you after because I
Were
want
you
you to.
cheating on me, Ari?
I was
Is that
cheating.
what oh my goodness gracious, guys.
I'm gonna connect
Heart's
you with
broken.
this fellow creator because I think you'd be just a good candidate for his podcast as well.
Okay.
And we were having a good conversation. Yeah, you can get in on that three-way, man.
Oh gosh.
we
There's a
we were
visual for you guys.
we were having a good conversation about when to invest and how to invest. And I just said again and again, it's just a shame that you don't go all in when you have the opportunity to go all in. And what I meant by that was you get this massive opportunity and there's always something in the back of your head that's like, well, wait, like could this be my big moment, or maybe there's more to come or whatever it is. It's just like when you have that gut feeling, go all in, because whether or not you go all in or you're 80, whatever it is, 5 years from that moment or 10 years from that moment, I mean, I'm looking back at 2020 and I'm just like,
Well, dude, even look back as recent as like April of this year, right? Same thing. And sorry to cut you off. I hope I didn't cut you off at least.
no, I was
Um,
finished.
okay, well, perfect. But to your point, it's I mean, exactly. I think there's been a handful of times since I started investing where I look back and I think, man, I wish I would have put more in at that time, and didn't. And unfortunately, I think just another example of having the benefit of hindsight. I think at least once you have to miss those opportunities, to realize that it was actually an opportunity, and hopefully that's a lesson that you learn, are able to learn, so that the next time it comes around, which there will definitely be a next time, which is actually the good thing in all of this. The market, moves in cycles, it ebbs and flows, and so, if you miss one opportunity, there's bound to be one in the future again, and hopefully when it presents itself, you'll have learned enough from the last time where you weren't able to take advantage of it as much, or you didn't take as much advantage of it, and then you can go a lot heavier and that next time around. Um, I don't know what I was going to say beyond that, but I think the point I was trying to make was I think it is for for some of us it's a lesson you have to learn the hard way for sure, just like so many other things in this game.
Yeah, for sure. And I look at it and I let 2020 be the biggest lesson learned, for me, to never let that happen again. And you know what? It happened again
Yeah.
because it wasn't, what it was like a year or two ago, I think not that it necessarily happened in that I wasn't ready, well capitalized to throw money into the market, but I was sitting on a mound of like $25,000 and waiting for this another big opportunity because maybe it would come. And that particular year, 2 years ago, I let $25,000 sit in the sidelines. So
Mm.
someone there in the comments just said it's way easier when you're just dollar cost averaging. And I want to totally agree that it is so much easier if you simplify this process and continue to dollar cost average. Now, when that big golden opportunity comes along, I would just put your DCAing strategy to the side and then go all in. I kind of use the ebbs and flows of the market to my advantage every week. I invest money every single week, no matter what. That's, come Thursday or Friday. If I didn't make any investment moves earlier on in the week because of a deeper red day, Thursday or Friday, boom, I'm throwing money into the market. If it's green, money's going in, but if it's red, double it up. And
Yeah.
that's been a great strategy for me now. And I really, I don't like to sit on cash at all. At all.
Yeah, well, that's something I was actually gonna ask you. I think you maybe probably already answered it, but I think one of the things that keeps people from going a bit heavier during those times when those opportunities present themselves is because you don't know, and it's impossible to know, but people don't know where the bottom is. Like, when is the right time to go heavier? Because it looks good today, but tomorrow, just based on the trajectory, tomorrow it's probably going to be lower, and it's going to be lower, and it's going to keep going lower until it doesn't. So, how do I juggle those two things, wanting to take advantage of the opportunity in the midst of this volatility where it seems to go down? Because obviously you want to buy at the most opportune time. You don't want to miss out on that opportunity, but also you don't want to buy too soon because it could just go down the next day. So how do you, and like I said, I think this is maybe where you already answered it, but how do you know how much to invest during those times if you are going to go heavier? Is there a rule of thumb? I think maybe that's the part that you answered, but let me know if I missed that.
Yeah, I think every investor has to come up with their own rule of thumb. You should have your own, policy for yourself. And, as I always say, and I did mention this in the podcast that I was on earlier today, like, you really do have to become the CEO of your own life. And
Yeah.
so in becoming the CEO of your own life, I mean, this is an all-encompassing, in my opinion, um, type of outlook that every little thing that you do, like everything I do, Ryan, I'm like, okay, what is a CEO in this position? How do they act? What do they say? No CEO would just throw money around. A CEO wouldn't just refuse to look at market headlines. Like, a CEO's head, if you really think about it, they know what's typically going on in the market.
Hmm.
They are cautious with how they spend their money, what they're putting their money towards, all of that. Now, when it comes to investing, I mean, I think everybody just has to have SOPs for themselves, standing
Mm.
operating procedures, and you should stick to those procedures no matter what. Now, for me, my go-to strategy is, if I like it at X price, then I'm going to love it at Y price.
Hmm.
And then I'm going to absolutely fall in love with it, when it just keeps dipping down. But I think for each and every investor out there, because we don't know what we don't know, you can't sit and wallow about what was or what could have been. It's just like, again, the conversation I had earlier with this guy in the podcast, he was sharing some of his regrets, and he was like, yeah, but if I only bought
Hmm.
Nvidia, or if my dad actually way back in the day had bought what this stock, and
Oh,
then
it's his
since
dad's
then,
fault. It's his dad's fault.
well, no, he was saying it could have been all
Okay.
generational wealth, and I'm like, man,
Okay.
you can't say any of that, because no one knew. No one
Yeah.
knows, so you can only operate based off the information that you have. And I think that's what makes life freaking awesome. That's what makes life awesome, is that you can only operate based off the information that you have now.
Mm.
And if you
And
knew what was going to happen a week from now or a year from now, I mean, it would be pretty boring, in my opinion. So I sadistically like the fact that I can't tell the future, and it's anyone's guess what, come Monday morning, what futures are going to look like, and how the day is going to play out, and followed by
yeah.
Tuesday, Wednesday. But when that opportunity is there, again, if you like it at X, you should love it at Y.
Yeah, that's such a great point, man. And as you know, going through this, especially this past week, seeing things go down and buying the dips and seeing it continue to get lower after I've already bought the dip. You know, the dip just keeps on dipping, except for Friday. But you know, in the midst of all that, that's a thought that I've really, really been trying to hold on to. That exact thing right there. If I like, let's use, I mean, even Watsco, the newest addition to my portfolio. If I started my position in Watsco at like 370 or something like that, and I was stoked to buy it there. I thought it was good, but now it's down to like, I don't know, maybe like 330, or actually no, maybe it's in the 340s now. But anyway, the gist of it is it sank quite a bit below, maybe 10% below where I initiated my position. And so I've watched it go down as I've been buying more and more and more, seeing it get lower and lower and lower. And that's definitely something I've had to remind myself of. If I liked it at 370, I should love it at 320 or 330. I should love it the lower that it gets. Um, and attached to that thought is something that I have to remind myself of, and I think all of us actually have to remind ourselves of pretty regularly during these volatile times, is that what is the it? If I loved it, what is the it? Okay, it is the stock, but the stock is not just this thing that randomly goes up and down. The stock, and this is something that I think is easy to forget in the midst of all this chaos, the stock is representative of a living, breathing business. Okay, it's especially these big profitable ones. These aren't, you know, super fragile things that are going to break just because like the share price goes down 10% or whatever. During times like this, there's a chance that that 10% drop might not even have anything to do with the company itself. And so I do think that that's something we really need to keep reminding ourselves of, is that these things that are going down right now, these are businesses, and we need to think like business owners as the CEO of our own lives, but also of our own portfolios, of our own little ETFs that we're building, this wealth creating vehicle for the long term. Um, you know, in the grand scheme of things, it's going to be fine. This business is still very much intact. It is still growing. Maybe they even just raise their dividend, like, I don't know, double digits or something like that. And so I think it also helps to detach from what the share price is doing and remind ourselves, no, this is a business. They're still generating profits. They're still generating free cash flow. And at the end of the day, that's the thing that you need to focus on. And I've heard, I think I saw a post on Blossom about this, which, by the way, shout out to Blossom. You guys can see both my portfolio and Ari's portfolio on Blossom. There's a link to it in the description. I think I saw someone post about this on Blossom with some sort of example. Like, let's say hypothetically you bought a business, some sort of widget making company. It's private, and maybe you started it or bought it. I don't remember. But they basically went through this whole story about how you have this private business that did, you know, so much in profits this year, and then they did so much in profits the next year, and even more in profits the following year after that. And throughout that time, maybe you didn't know what the business was worth, and so you were just stoked about um, you were just stoked about the profits continuing to grow. But then in this as well, there was another side that said, hypothetically, let's say that during that time the profits were growing, you did know the share price, and you know one day it was up this much, so you were stoked in addition to the growing profits. But then maybe this next year it was down for whatever reason, it was lower than what you bought it for. Someone offered to buy it for a lower price than what you bought it for, so you were depressed about it. And so I guess the point that I'm trying to arrive at is that the share price is not always actually rarely is it, especially in the short term, a good indicator of the health of the business. And so I think you can kind of just forget about it.
Sounds for a moment like you were describing Amazon. That was Amazon's actual story at the early stages of Jeff Bezos building this behemoth of what we now know today as like the one and only Amazon, you know, that everybody loves and uses.
Yeah.
And, you know, in the early days of Amazon, Jeff Bezos, in a couple interviews, he talks about, you know, the moment where he's watching Amazon stock price plummet, but yet he's looking at all the fundamentals of the company, and they're not only, you know, well off, but they're booming. And so
Hmm.
how many times are we misreading a company because we're looking at the ticker and the stock price and not actually doing our due diligence as investors to do the one thing that we all need to do as investors, which is due diligence, you know,
Hmm.
and actually investing because we understand the health and longevity of the company. That's the key. And so
Yeah.
again, you know, people are so easily fooled, I think, these days by news headlines, and that's what sells. That's also what's very scary. So you do have to kind of become pretty unemotional, and I think in all aspects of life, it's very healthy sometimes to disconnect yourself from emotions before you make a decision, because your emotions can drive you to some crazy decisions, to buy,
Yeah.
to sell, okay? And then in other areas of your life, after as all of us podcasters do and creators, after or before, you film something, you always talk longer after the fact. But I was talking with this fellow creator, and he was talking to me about his earlier years and how he got himself into some bad relationships and a bad marriage and this and that, and then the marriage failed, and he goes, I said to him, look, something that's been beneficial for me is, I experienced a lot of hardship and just like the home that I came from and everything so young, that I learned something crucial in all of it. And that's how I don't want to be. That's how
Mm.
I don't want to show up, how I don't want to make decisions. And so now when I go about making life decisions, I have the ability to really compartmentalize and then just focus really on this one decision. And then most importantly, in that compartmentalization, um, take the emotions out. Okay, let's think very logically now. And so every stock investment, every portfolio move I make, I detach the emotions. And that's even been, by the way, a process of refinement, because not too long ago, Ryan, maybe a year and a half ago, I was sitting in a dog park texting you about Johnson and Johnson, remember?
Yeah.
And I was
Yeah,
like, I don't
absolutely.
I don't want to sell it. I really like the stock, but and that was really the beginning of me really, really refining myself and really detaching now from even my affinity towards stocks. It has to be an unemotional game.
Well, I think on one hand, I'm going to slightly disagree on another hand. And I will say, like, as someone who, I mean, the great majority of my portfolio is in individual companies. And I think about, why do I own the companies that I own? I think there has to be some sort of affinity for those companies. I mean, Starbucks is a great example, and we've talked about this before on the episode. I love Starbucks. I love their coffee. I love the brand. I can smell Starbucks when I say the name. I love everything about the company. It's a really nostalgic one for me. I've got a personal attachment to it, which is one of the things that drew me to it as an investment when I first got started with it. And so I think you have to care about, and you kind of have to love the companies that you own. I think that that attachment also is going to help you hold on to them through the tough times. So I do think that there's a benefit there. But to your point, that can also cloud your judgment when it comes time to make tough decisions. And for me, when it came to Starbucks, as everyone knows, I ended up selling out of it, which I think was a good move. But it was tough because I love the company so much. But this is also this to your point, where you do have to be objective about it, and you do have to take the emotion out of it. I think it's okay to, like you do, compartmentalize those two things. Yes, I love this business, but I also have to do the right thing, and I have to be rational. And I don't think that those I think those both of those things can exist at the same time. I still love Starbucks. I'd love to have it back in the portfolio at some point, but there are some things that need to change about it before that happens. And so I do think that is kind of a juggling act at times. And I think about the other positions in my portfolio, Clear Secure, Zoetis, Watsco, Lowe's, you name it. And the same is true. Like, there's something about those companies that jumps out to me as being special. Maybe it's their financials, maybe it's what they do, maybe it's the management team. I mean, realistically, it's a combination of all of those things. But still, there's that affinity there that makes me care for these companies, and makes me want to invest my own money into them. Now, it just conveniently turns out that they're actually, at least for now, they're good businesses that are growing, and in a lot of cases don't have too much debt. Um, and so it works out like it's a win-win there. But at the same time, if that situation were to ever change, which you'll know because you're keeping tabs on your investments, then yeah, you need to set the emotions and the affinity aside, and you need to really think objectively about what is the right move for your portfolio.
I want to equate this to dating or,
Hmm.
just
Spot
relationships,
on.
right? I do think absolutely to your point, there needs to be, an initial spark there of attraction and then this love, right, that comes about. But, over time, I think when you start to dive into the numbers, because numbers don't lie, the data never lies. That's something when I worked at Tip Ranks, we always said, trust the data, trust the data, trust the data. And so numbers just don't lie, and you can, okay, I'm not talking about a one-off miss on earnings. That's crazy
Yeah.
if you get emotional about that and sell. I'm talking about earnings season after earnings season, year after year. Okay. Is it hype around the stock? Is it, your love for the stock? But at the end of the day, these numbers still aren't looking right, because I do believe, right, when we start to make this comparison to dating, okay, it's like you see your person, you're like,
Hmm.
oh, attractive,
Yeah.
amazing. That should be, and in my world, right? Attraction is the first thing that I'm just like, let's go, right? I see her attracted to her. Now go up and speak. Okay. And
Yeah.
now what
She's
comes out
she's
of,
generating she's generating a lot of free cash flow.
yeah,
She's got a
exactly.
very strong balance sheet.
What comes out of her mouth, right? And how she speaks and what she says, everything thereafter that becomes, okay, well, how do I get a baseline for character, right? And that's what I really think you need to be doing with stock opportunities.
Hmm.
You see something sexy, attractive, hot, boom, put your eyes on it. That's more than acceptable. But from there, you have to do your due diligence and move pretty methodically and slowly to really get to understand, right, what you're about to get invested into. And it's really no different than dating here, because
Yeah.
again, in the world of dating, you better get to know pretty slowly and methodically who the heck you're talking to and what you're about to get yourself into. And you're probably going to go through some trials and tribulations, aka volatility, together. And how you work through that is everything. But because numbers don't lie here, I'm going to keep running with this analogy until I
It's
can't
good.
anymore. But, you know, when volatility hits, when life hits, right? Everybody, all coupled up, they're all good when
Hmm.
times are good. It's when times are bad, I actually really welcome and embrace volatility in my life. I want to know who's in my circle to stay and who's in my circle that, is floating around that I don't really even need, might go adrift, whatever, can't rely on. It doesn't matter who you are, but when things get going in life, because they will, you're either in the midst of volatility, just getting out of volatility, or heading right into it. There's only three positions in life, right? And so with that thinking, it's like, for me, the most important thing is to know that the person that I'm with is going to be able to stick around. And that's going to require a deep dive on, again, that character that they have, what they're bringing to the table, how they handle volatility, how they handle the storms of life. And then, of course, when things come out of the woodworks, I just, now we're talking really about numbers in my head. you you have to be clean, a clean balance sheet, right? I don't want to be surprised. And so that's another area where I just think we need to be, as investors, in love with what our investments, have the passion for our investments. But when push comes to shove, we need to get objective. Okay, because if it's that stock, right, that you're dating,
Yeah.
or whatever, goes awry, things happen in life, and now it's presenting numbers time and time again, you need to get out of the relationship. You'd be a
Hmm.
fool to stay into it, in it.
Yeah. And sticking to this analogy, which actually is the perfect one, those tough times, whether it's in the stock market or if it's in the relationship. So funny that we're making this comparison, but it actually is a good one.
It's
you
hard
know,
to run with it for like 5 minutes. I just keep going.
well, no, you did a great job, man. That was great. But during those tough times, when you get through it, it's either going to bring you closer together or it's going to tear you apart. That's certainly true in the relationship, but it's very much true in the stock market. During times like this, what is the management team saying? What is the management team doing? What are the numbers showing? That's either going to reinforce your opinion of the company and your affinity for it, or it's going to make you maybe second guess your initial investment thesis. Maybe this isn't what I thought it was. Maybe the management team isn't as straightforward as I wanted them to be. Maybe the numbers actually don't show the reality that I had seen in the first place. And so I think, yeah, you'll come to learn a lot about the companies that you own. Number one, just through time. The longer that you hold them, the more acquainted you're going to be. But also number two, you're going to learn a lot about them probably faster. And also you'll learn more about how you actually really feel about them. Um, when things are not so good. I think that that's going to reveal a lot. I do want to pull up a comment here from Fast Eddie. And by the way, guys, I've saved a few of your guys' questions along the way from the live chat. We'll go through them here pretty quick. And if you guys have any other investment questions, drop them in the chat. And we'll try to get through them or get to them in this
I was
episode. But
just going to
Fast,
tell you to pull this comment up
yeah,
because I actually had something to say about that.
okay, yeah, take it away, man. Really good comment.
Yeah, first of all, Eddie's right. It might not lie, but it can be manipulated. And so let's go right back into our analogy of dating. Your partner might not lie, but first of all, manipulation is lying. That is a form of deceit. A half truth is a full lie, right? I put that out there. That's how I live my life. A half truth, full lie. That's what you get. So if someone's manipulating, the numbers, that is in fact a lie. And in my world, the truth always comes out. You think about like an Enron, right? You can only cook the books for so long before your house of cards falls. So again, as the investor, it's up to you to really do some investigating on, hey, well, is management sharing truthful information, right? Are there trends? Even if you have the speculation that the company is not necessarily on cue with the truth, that in of itself, just like in a relationship, is not healthy. So if you're second guessing the company in the first place, you're in the wrong relationship. You're married to the wrong stock. There's not a single stock in my portfolio right now that I second guess. And they come out, with their quarterly earnings, and I listen, and I, from based off of everything else and all my other findings, everything's on cue with what I feel to be the truth. And I feel comfortable with those investments. But at any moment, right, if I feel there's manipulation, that's already a massive red flag.
Yeah, well said, man. I will say, how do I want to word this? There. So the whole premise of what we're talking about is that you have to
Dating.
look at the financials. You have to look at the numbers. The numbers tell the story. Fast Eddie here, for those of you listening to the podcast, his comment here said the data might not lie, but it can be manipulated. And I want to say that is true. There are certain metrics out there that are easy to fudge. Like even if you look at earnings per share, well, let's actually start with net income. There's so many adjustments that can be made to arrive at a certain net income number. And subsequently, if you do that on a per share basis, the earnings per share, that can be manipulated as well. This exact thought is why Warren and Charlie were so against EBITDA, because it's a bit fudgy. It leaves out certain things like interest, taxes, depreciation,
Appreciation.
amortization, which are maybe non-cash expenses, which is why people think you can leave them out. But they were expenses at one point up front. And so anyway, there's all sorts of things that can be manipulated. And I think that it is our responsibility as investors to number one, know where management's incentives are. If they're getting compensated on like EBITDA growth or earnings per share growth or things like that, well, then those are the metrics that they will try to optimize for. and maybe that will come out in the wash and how they behave. So I think that it is our responsibility to be aware of those things and to react accordingly. But also number two, like, focus on some of the metrics that are not as easily fudged. I think free cash flow is a good example of that. It's a bit harder to manipulate free cash flow than it is earnings per share. Even further down the line, I think this is why investing in dividend paying stocks is, at least in my personal opinion, such a, I don't want to call it a hack, but it's such a good way to gauge the growth of a company, because at the end of the day, the dividend is the dividend is the dividend. There is no manipulating the dividend. It's paid out to you in the dollar amount. There's no question about that. And if they can continue to pay and grow that dividend over time, that's only going to be made possible through um, unfudgeable growth. And so I think you need to look for the metrics that are difficult to manipulate and focus on those. Like I said, free cash flow is great. Dividends not it's not imperative, obviously, but I think it does help. And for companies that don't pay a dividend, I think, yeah, look at the free cash flow. Revenue is also another one. You really can't. I mean, maybe you can, depending on the company, but for the most part, like, you can't fake the sales. If a company's not growing their sales, they're not growing their sales. That's a pretty easy one to tell. So I think that those two things are definitely part of your due diligence. And at the end of the day, there's just a few basic metrics that you can keep tabs on that will help you honestly gauge the direction that a company's going over time. I think the dividend's one of them. Obviously, I'm definitely biased in that regard, but I do think that that's true.
No, I like your point, about which numbers or numerics are easily, more fudgeable. But, to your point you were making before, just think about something as simple as depreciation. You could choose to utilize accelerated depreciation, right? And so, again, depending on how a company wants their earnings to reflect, they can use any numerous amount of tactics to get to the numbers that they want you to see. But over time, again, I think, again, just in a relationship, one little white lie, and 20, 30, 50 lies later, right? The truth comes out. So eventually, like I keep saying here, it's like, the numbers might be fudged one go round, two go rounds, three, four. But if you're a diligent investor and you can kind of get your feel around, especially, I like someone said, in today's day and age, you can't really outsmart the market. There's so much information out there today, and there's so many resources for all of us. There's really no excuses not to have your head on the swivel and to become very familiarized with your individual investments. But also now, to this point, it presents a very strong case to really remain a broader market, index or ETF type of investor, just so you don't really have to find yourself in these positions if that does scare you away from investing. And I hope that Ryan and I aren't scaring away
Yeah,
investors
definitely
from
not.
investing into individual stocks.
Well, this is kind of the fun. I think this is kind of the fun aspect of it, is being able to think about the market and think about these companies at this level. You're kind of like you're kind of like a detective of sorts, just trying to uncover what the truth is and what the truth will continue to be. And so I think that there's some fun in that. It's not fun for everyone, obviously, but I think for us it is. And to this comment right here from Omnibus, which is great comment. For those of you listening, the comment says, in today's day and age with easy access to information, it's quite presumptuous to think you know more than the market. And I want to take this in a different direction a little bit. Um, I would never personally presume, and I don't think Ari would either, to know more than the market. But I think that it's not taking into account uh, the human emotion that definitely plays a role in directing what share prices do. And I think that there's having the information, and there's multiple ways that you can react to that information. And the information in the market might always be taken into account. Maybe that's where it's efficient. But at the end of the day, the market participants are human beings, which are all imperfect and irrational. And we don't always think, the way that we should. We don't always make the right decisions. And that's often reflected in the share prices, um, in the stock market at large. That's why like the fear and greed index exists. It shows, I mean, it's a scale based on human emotion. And so the information might be there and um, taken account of, or might be accounted for, but maybe in the short term, it's not in the right way. And so I think what I'm trying to say is I, I don't think the market's fully efficient, which is what I think he's possibly saying here. And the reason it's not or ever will be is just because once again, it's the stock market is made up of people, and we don't always have our head on straight, and that's reflected in share prices, which is where the opportunities that we've kind of talked about in this conversation. That's where these opportunities can present yourself. You're not really trying to take advantage of how do I say this? You're not really trying to take advantage of unfound information. You're trying to take advantage of a misguided reaction to that information. Hopefully that makes sense. Does that make sense?
Yes. It brings to mind odd lot theory. Are you familiar at all with that theory, Ryan?
Uh-uh. Gonna
So
learn
odd
something new
lot,
here.
yeah, here we go. Get your textbooks out, pencils and notebooks. But odd lot theory, it's a contrarian theory that just suggests that it's the small time investors that are typically wrong in their timing of the stock market. And so why it's called odd lot theory is because you're really, anytime a retail investor, a small scale investor sells like less than 100 shares, a lot equivalates to 100 shares. So odd lots
Okay.
are just anything less really than 100, or something you can't make 100 to. So this whole theory is based on the fact that, well, the market's made up of people. We're emotional people. And typically when the market freaks out and these small time investors start to sell a lot of their shares, they're not selling crazy amounts of crazy amount of lots, right? In hundreds of thousands. They're selling usually like underneath 100, right? So some Joe Schmo retail investor has like, 60 shares. Boom, let me get rid of them, right? And
Yeah.
so this whole theory is just based off the fact that there's so many emotions in the market that larger scale investors eat up the opportunity when these small scale investors are selling. And it just goes to say that, and I really do think there is something to say about this, because something else I brought up earlier today was the fact that the biggest investment you can really make, as cliche as it sounds, is in yourself. It's in yourself, buying the books, or maybe it's a course. I don't know. Maybe, yeah, I'm not again. If the favorite YouTuber or whoever it is that you like to follow has a course and you trust them, take the course. Or go to. Well, no one goes to Barnes and Noble, I feel like, anymore. I still go. So, you know, go to the
Love a good
bookstore.
bookstore.
Go to the bookstore, buy books. Invest in yourself. There we go.
Oh,
Um, because if you invest in yourself and you start to learn, different theories, different strategies, your investor profile. This is not to say that you're going to be, the perfect 10 out of 10 investor who never loses. You will inevitably lose every now and then, but you will be more comfortable with those losses because you will have known what went into the loss, if that makes sense,
yeah.
versus just being totally irrational and emotional, throwing money into the market and having an expectation that it's all going to go right. And so I would rather be wrong a dozen times, having done all my research and having had confidence in an investment, than freaking going to the casino of the stock market, throwing money in and not really knowing what the heck I'm doing.
Hmm.
Now, that is a big problem. And that's where a lot of emotions come in. Because if you do your research and you do your due diligence, I'm not going to say you're not going to have panic moments. Maybe you will. For me, those have totally ceased to exist.
Yeah.
Even when right now, my portfolio just a week and something change ago was just over 393,000. Now all of a sudden I'm sitting at 380. You know, so, but I'm not panicking. I'm rooting for more red days. That comes with experience and knowledge that I have as an investor. And if you don't have that experience, you can certainly at least study up on and learn to educate yourself on what you can expect to be prepared as best as you can be before you get that real life experience.
Yeah, very well said, man. Okay, so why don't we jump over? We've got a few really good comments that I wanted to go through here before we wrap up the conversation. This first one was asked like right at the start of the show. It's from Casey, and Casey says, Ari, have you seen the Red Bull skydive obstacle course? Just want to know what you think about the wingsuit. Would you try one on a dive? Also, thoughts about ADP stock. I've been buying the dip. What do you think about the wingsuit? I don't know anything about this Red Bull obstacle course, but what do you think?
Yeah, admittedly, I don't know anything about the Red Bull obstacle course either. I will have to look it up, but I can definitely say that I am a thrill seeker. Ever since being a firefighter, my thrill levels are off the freaking roof, off the charts. So I'm totally into it. When I was skydiving in Mexico, I was talking to one of the fellow skydivers, one of the instructors there, and he had actually, what was it? What's the crazy jump? I don't know. I'm blanking on the name now. You basically jump off of buildings.
Oh, like base jumping?
Base jumping. Yes, thank you. And we had a really good conversation about base jumping, and I just wouldn't put it past me to do anything of that sort, because yeah, I'm a thrill seeker at the end of the day, and I love the thrill. I don't know about the obstacle course, but I would certainly do a wing jump, and I hope by the end of 2026 I'm fully licensed to just jump out of planes on a global scale wherever I am in the world.
Yeah,
ADP stock, I don't know. I'd have to look into it.
yeah. It's been a while since I've really spent just time looking into ADP. But I did pull up. I have the company pulled up on Snapstock, just looking at some of the high level financials, and I mean, its financials are pretty impressive. Like revenue, earnings per share, and free cash flow are pretty much just straight up into the right, very consistently without skipping a beat, which makes sense because their revenue at, I don't know if all of it is, but the great majority of their revenue is recurring, subscription based. So I think it's no surprise to see that. I think that's a great sign. Very high profitable, or high margins as well, I should say. And in fact, the margins are growing. Both the net profit margin and the free cash flow margin have grown by like 6 to 7% percentage points, I should say, over the past decade. Not to mention, or yeah, not only that, but they also have been a very solid dividend grower, like double-digit dividend growth rate, pretty low payout ratio, or a pretty decent payout ratio, I should say, about 50-60%, and also very high returns on invested capital. We're looking at like 40% just in 2024. So from top to bottom, it looks like a pretty solid business. I think from my understanding, the big question about ADP, like a lot of companies out there, especially a lot of software-based companies, or even online-based companies, is how artificial intelligence will impact their business. And to that extent, don't really know. I think it's probably too soon to tell. But from what I'm seeing with ADP, just the high level numbers, it looks really strong. And I think they're down like 15 or 16% in the last year. So there does seem to be a pullback. But at least in this stage of the game, I don't think we have any reason to believe the company is going out of business. So I think it's, I don't know, solid company. But I don't really have too much of an opinion on it beyond that, just what I'm seeing with the high level numbers. Omnibus here says ADP is a great buy for sure, especially as a long-term investment, regardless of next month's employment numbers. And I guess that's a good point too. There's a lot of concerns about the job market right now. And I think some of that is actually tied to AI as well. But yeah, from a long-term perspective, companies are still going to need to do payroll. They'll still need help with HR services and stuff like that. And I think there will likely be a place for ADP. But really good question there. There's another one actually, jumping over to the next one. Curious of our thoughts on Open, which I think is OpenDoor. Do do we think it's a cult meme stock, or do we see potential? Truth be told, I've not spent really any time with this stock. Even with that, even though I haven't spent any time with it, feel like I see it every time I open up like Blossom, someone's talking about it. So it's definitely hyped up. But do you have any opinions on this one, Ari?
I'm closed.
Oh yeah.
I
Okay.
you know, like to your point, you know, I definitely see a lot of talk about open. I see a lot of talk. Usually, when you see a lot of talk on the Blossoms and X's of the world, I actually don't enjoy getting too interested into those stocks because that's where
Yeah.
it can get a little bit dicey. You're going to get a lot more volatility with them, and you know, my investments, while I'm focused on growth, I'm not trying to find any meme stocks or anything that's going to be pressurized and soar to the sky before dropping, you know, like a rock. So it's for everybody else to have fun, and I'm going to stick to my investment strategy.
Yeah. Very well said, man. Just at a quick glance while we're still on the subject, it looks like the company, they're not generating any earnings. Looks like maybe in the trailing 12 months they have brought in some free cash flow. Revenue looks like it's actually really gone down in 2021. They did $8 billion in sales. In 2024, it was 5 billion. So I'm not really seeing anything interesting about this company if those numbers are correct. I just don't really see the appeal. And it's probably actually what's the share price done? I mean, in the last year, it's up 200%, and it looks like it is kind of starting to trickle back down. So I don't know. Like Ari said, I stay away from that stuff, which is really no surprise. But okay, this is actually an interesting one. Jumping over to the next question from Vasco. Interested to know my time on the 5K. So last week I was talking about doing a
Oh, what a
5K.
great question.
Yeah,
I
and you guys
totally
are going to be
forgot.
mad at me, but I actually didn't end up doing it. I did not end up doing it. So the race was on Sunday,
Ryan,
and
I
in
put
Vegas.
10K on you coming under 20.
Geez, man. Well, I mean, does it still count? I zero, less than 20. But yeah, I ended up not running the race. On the day of it, the weather was really bad in Vegas, and it was going to be a family affair. Like my in-laws were in town, we were all going to go and do this walk, or I was going to run it. They were going to walk it, and just with the weather being bad and having the baby, we didn't really want to take her out in that. Probably wasn't going to be a good idea. And so we just decided to skip it. So I did not run the 5K that day. I did, however, I got a very long run in, probably my longest run since the baby was born. I think I ran just over 9 miles on Sunday to make up for that. So hopefully that's good enough for you guys. But yeah, unfortunately, I don't have a time for you. Don't have a time. I feel bad. I knew I was going to get asked about that on this episode, but okay, what else we got? This one's probably a good one for you, Ari, if you feel so inclined to share specific ETFs. I don't know if you can or what the
Yeah,
restrictions
good
are
tech
there, but
ETFs. Look, I
yeah,
always just say this, just so everyone's doing their own due diligence and research, is the fact that a good tech ETF, just like a good broad market index or ETF, is one that covers, or is one that's all encompassing, right? So whatever ETF that is for you, just make sure that those fees are low. When I start to look into, you know, indexes and ETFs or any funds that are out there, what I'm really targeting is a safety net, because when you're investing in my opinion, when you're investing in funds, you want to be able to invest at ease with reliability and an assurity that your money is going to be there. Um, you know, not to get too far deep into the weeds. Um, I just think today, with all the amount of products that are coming out, everyone's still now looking for fast cash. And we got to be well aware that depending on the funds that you're getting invested into, if you don't read the prospectus, what you can find is yourself in a position where the fund that you're invested in is reset daily. So you want to make sure that the funds you're invested into aren't reset daily. They are truly the buy and hold type of funds. They have low fees. You don't want to be paying crazy fees for something that's as simple as a broad market or broad sector ETF. Now, you know, anything from your Vanguards to Schwab's, Fidelities, you know, they all have pretty much, Ryan, I feel like today, man, there's nothing new from any of these big companies. They all lowered their fee structures. They had to be competitive. The one thing I find with the bigger sharks, like the Fidelity, Schwabs, and Vanguards that they still don't have is fractional shares. That's usually like the Robin Hoods of the
Yeah.
world. Maybe I'm wrong though. I think you have Schwab.
Yeah, I think Fidelity has fractional shares on everything at this point. Once again, I could be wrong about this. Let us know in the chat too if any of you guys are over at Fidelity. I think Fidelity has fractional shares. Schwab is still very limited. Schwab is still really limited on the fractional shares. Like you can't buy fractional shares of any ETFs, not even Schwab ETFs. Like you can't buy fractional shares of SCHD or SCHG or any of them. And I think you can only buy fractional shares on S&P 500 companies. So Watsco cannot buy fractional shares on that, which sucks because it's like, it's $300+ a share. So it kind of does blow in that regard. I really wish, I do really wish, as much as I love Schwab, I wish that that would change. I don't really know. I don't really understand why they haven't expanded the fractional share functionality on their platform. I mean, they're coming out now and talking about like being able to add cryptos to your IRA. They're now talking about getting into crypto and stuff, which is fine. I don't have any issues with that. But I just think that okay, you're going to go down that road, but you can't give us, fully fractional share optionality. It just doesn't. This doesn't really compute to me. So I personally think that that is. I mean, that's something that I'd like to see changed personally. I'll just leave it there.
Ryan for Schwab CEO 2026.
Yeah, if you want it ran into the ground. With all of that said, too, like as far as the company goes, as far as the stock goes, it's one that I've always kind of been keen on because it seems like a pretty solid company. The financials look really good. So, I mean, they must be doing something right. But
We do have confirmations there in the chat that Fidelity does in fact have fractional shares. I can report on behalf of Vanguard that at least as far as I know, there are no fractional shares with Vanguard either.
yeah,
Unfortunate. I think eventually they will come around to it. They have to. Maybe they're just very slow to. But all that to say, when you look at your funds, keep the expense ratios low, especially if you're the buy and hold, not doing much else with it. And then most importantly, it just covers the whole pie.
yeah. Kind of, last comment, kind of on this topic. This was from Joey a few minutes ago. He said, I've got about a 70/20. I think he changed it to 70/30 split in the index funds and individual stocks. It's crazy how the indexes are so heavy in the Mag 7. Because of that, would multiple sector funds be better than an index fund? I mean, what do you think? Is that I don't know. Should you get it like a consumer staples ETF, a REIT ETF, an industrials ETF, a healthcare ETF, and kind of layered up that way, or is it or does just the S&P 500, which is tech heavy, still work? What do you think?
No, I think you should absolutely remain. So first of all, let me say this: if you're going to do anything, I think at max when it comes to funds, you could look into a 2-fund portfolio. And
Yeah.
I think the moment you start adding a bunch of, sector funds into your portfolio, you're again kind of playing the same game
Hmm.
as someone who's trying to load the boat on 40, 50, 60, 70 holdings, trying to outpace or outbeat ETFs. Just pick one,
Yeah.
tops two. If you want to have a 2-fund portfolio, again, one that covers the broad market and then one that's sector specific. In that case, maybe it's tech, maybe it's not tech, maybe it's a special, special situation type of fund. Whatever it is, you can, I think, max treat yourself to 2 funds. And I wouldn't go
Yeah.
crazy, but you also have to keep in mind what an index does. It's tracking, right? So let's just say one of the Mag 7s, falls out and it becomes the Mag 6, right? That's automatically going to be taken care of. You don't have to do anything. And so I think once now you're looking at all the sectors and you're trying to add, all these sectors into your portfolio, you got to have, again, another watchful eye on it. The ETF or the index fund is there so you don't have to keep a watchful eye on your portfolio.
Absolutely. That's the main point right there. Like if you're going to be loading up on all these different ETFs, it defeats the purpose of having ETFs in the first place. Like you don't want to actively manage your ETF portfolio. That doesn't make much sense. And I will say, if you are concerned about too much exposure to the Mag 7, you could always go with like the equal weighted S&P 500. That's not a bad option either. From my understanding, and don't quote me on this, but from my understanding, over a long period of time, the equal weight and the market cap weighted S&P tend to, perform pretty similarly. Um, except for these last few years, because now the S&P is so heavy in the Mag 7, it's really pulled away from the equal weight. But across a long period of time, with the exception of these last few years, from what I've read, from what I heard on various podcasts, and you can obviously double check this and look it up for yourself. I just haven't done it yet. It seems like the performance is pretty comparable, which also does beg the question, well, if it's pretty comparable, why wouldn't you just go with the market cap weighted? I don't know. More than one way to skin the cat, and it's good to know that you have options. So,
Yeah, it's exactly right. Someone else just threw there in the comments that everything just falls back to buying the S&P, and I completely agree. You could try to cut this pie a million different ways, different slices, but the reality is that the whole pie in and of itself, you can't really go wrong with
yeah.
500 of the biggest, baddest companies that the United States has to offer. Then you also get into talks with some people, and they start investing internationally, and I just don't see the need. I personally don't see the
Yeah.
need unless you really are familiar with those markets. But sometimes I just hear people like, yeah, you got to be diversified. So I bought an international fund. It's like, well, are you familiar with those international markets? Like, do you know what's going on there? Most times people don't even know. So at that point, it's just, it's stupidity. You need to be well aware of what you're investing into, not just diversifying for the sake of saying that you're diversified.
hmm and you know, I don't think diversification is bad, but if you want diversification just for the sake of diversification, still there's a better way to do it than loading up on 100 different funds. Just buy VT, call it a day. That's literally everything. And generally speaking, the gist of it is, when it comes to ETFs, like, simplify it as much as you can, because that's what they're there for. They're there to simplify things and take matters out of your hands, so you don't have to think about it. So help them help you, I guess.
Love that.
So anyway, man, and any last thoughts before we call it a day, call it an episode?
Ryan, I'm just really happy that you're in Newport Beach. I'm really happy you're living your rich life as we speak.
Let me see if
And
I can show you guys the beach. Let me see. Oh, bear with
no,
me.
we got too much. It's too up. There it is. Oh
Yeah,
wow, man, you're right on the beach. You're like
right
right
there,
there.
man. Right there. Yeah,
What are you
stone's
doing in
throw
here
away.
talking to all of us?
I don't know, man. After this, I'm gonna go build a sandcastle. I'll tell you that. And I've got my shovel and pail right here, ready to go.
See, now that, ladies and gentlemen, is in fact the rich life. I hope, come January 1 to be somewhere in Asia. We'll see. By February, potentially back in Mexico with the Blossom team. So
Oh,
a
you're
lot
gonna
of good
go? You're
things.
gonna do it?
I believe so. I believe so. Just a lot
Okay,
of good things,
nice.
on the calendar. And yeah, I hope everybody has the opportunity to get invested, stay calm, embrace the sea of volatility that we're ebbing and flowing through right now, to ultimately then be able to live your rich life as well. We all join Ryan in Newport Beach, or at least somewhere in the world on a beach, if
Yeah.
that's your rich life. But that's what's on my mind right now, man. I'm happy for you. I'm happy for everybody who's joined us this chat, and just looking to become, leveled up as an investor.
Amen to that, man. Well, guys, thank you so much for hanging out with us this last hour and almost 10 minutes. It was another awesome episode, another great conversation. Thank you guys for the great questions as well. But with that, hope everyone enjoys the rest of their weekend. We'll see you next week. And I don't know, have a great day. We'll see you in the next one.